Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, which is amazing because he's usually on a due diligence assignment, Mr. Michael Becker. Michael, how are you?
Hey, Paul, I'm in my office for a change. How are you doing today?
Doing well. I'm out in the Old Capital office out in Kauai for the next couple of days, entertaining some clients that have done hundreds of millions of dollars with us. So we're entertaining those folks. You do a couple $100 million with us, you get a free ticket to come out to Hawaii. So we're having fun with them. They come in today. They stay a couple of days with their wives, and we have a good time. One of the things I wanted to talk about, Michael, right now is and I've heard this through a couple people, that there's still a lot of pressure for people to invest dollars into multifamily. And one of the things I heard is that if you're an international buyer of real estate, is that you want to invest those dollars in the United States. If you're a national buyer, meaning that you live here in the United States and you want to invest any place, that you want to invest in Texas. And if you're a Texas buyer and you want to invest, you look to Austin, Texas is probably one of your number one places to invest money in. So we've gone from the international to the domestic to the state, and now we're in Austin to kind of talk a little bit about what's going on in Central Texas. So Mike, you have some properties in the Austin area too. And so we'll talk a little bit about how you're doing with those properties down there. But in the podcast today, we have one of our friends that has been on the podcast before, Matt Pohl, and Matt does a great job down in Central Texas, and he is the managing director of Walker, Central Texas, down in Austin. So Matt, thanks for being on, and how are you?
Doing great. Thanks for having me on. Appreciate it very much so.
No problem. So I'm going to turn it over to Mike because Mike and Matt have transacted together, and so I'm going to get kind of the state of the market in Central Texas.
All right, Matt, appreciate you coming back on. We had you on about a year ago, I think this time last year, and what a difference a year makes. I think we were joking before we started recording that might have been the absolute peak of the market last year. So if anyone wants to go back and see what unbridled optimism was, go back 12 months and listen to that episode. Be probably a little different than today. But anyway, so maybe Matt, I know Paul introduced you, but maybe do just a kind of a quick little background on yourself for those of us out here that don't know who you are.
Sure. Thanks, Mike. Matt Pohl, Managing Director, Walker Dunlop in Central Texas. I started in this business in 2010 and have been at a couple of different firms along the way. We started this office, myself, Forrest Bass, Spencer Roy, in January of 2020. Kind of took off running. 90 days in, COVID hits, and over the course of the COVID environment to the current time, it's been nothing but a wild ride for the better, and currently not so great. Albeit we're busy. We've got deal flow. It's far more limited than it was this time last year. I would totally agree that the conversation we collectively had in what I believe was April of last year was kind of the onset of far more challenging pricing environment playing out. But, there's no doubt about it that it was an insanely competitive market, call it first quarter, early second of last year. Now it's quite a bit different. And I think the underlying theme is just capital market volatility, and where you had optionality this time last year on financing resources, you basically have one go-to, with the agencies being the most attractive debt option out there.
Yep. So you cover both all of Central Texas. So that's both Austin and the San Antonio and kind of surrounding areas.
Sure.
In between.
Yeah, that's right.
So you're physically located in Austin, and that's where you probably spend the majority of your time. Maybe kind of just for a point of reference before we kind of get into generally just talking about kind of state of the market. What was kind of your volume maybe last year, and how does that translate to kind of what you're expecting as a whole? Because I'm sure that's probably not atypical. That's probably what everyone is going to experience, kind of the relative change of volume to from last year to say this year expected.
Yeah, absolutely. So our entire team, which is Forrest Best, Spencer Roy, myself, Kevin Dufour, Kyle Pico, Allie Anderson. Last year we sold, I want to say it was 46 deals. It was right around $2 billion worth of transactional volume. Now, that was very front-end loaded for what it's worth. We were active in the third and fourth quarters, but when you compare it to the first two, considerably off. Right now, it's a completely different game plan, albeit I think you'll see 2023 a little back-end loaded more so than front-end. It's very difficult to put forward a prediction on what we will do as a team, but I can guarantee you it won't be what I did last year.
Yeah.
I would venture to say it's considerably off, but things are moving and changing very quickly. And if our BOV activity is any indication of an underlying desire to be transactional again, I think that you start seeing that play out sooner than most people realize. But I think it's going to start with older product. And for what it's worth for this audience, we tackle everything in Central Texas, from late 60s product to brand new Class A in lease up. We try to cover it all. I think we do a pretty darn good job of it. Ryan Epstein, who is in our Houston office, is an active partner on everything in San Antonio. And I think we put forward one of the stronger teams in the space for the region.
So let's kind of just talk about like where we sit now. So this time last year, there's quite a bit of inventory all up and down the property class from A to C, and kind of everything in between. I mean, we transacted on a deal in the late third quarter, early fourth quarter, I think, when we actually closed. Yeah. I kind of got the deal going in the third quarter. New construction deal, finishing up lease up. The market kind of changed from the beginning of the year to that point. But kind of as we said, I mean, talking with you guys, you had a couple workforce housing deals out at MHC when we last saw each other, and then really nothing on the institutional. And that kind of seems to be everyone else I talked to in Austin. There was very, very limited inventory out in the marketplace. Kind of, what's kind of the state of the market right now as far as how you see it? I know you're saying obviously expected to be a little bit back end loaded. You're seeing some BOVs, but what are you kind of feeling, experiencing in the conversations with people? What are their motivations? How's pricing adjusted from, say, this time last year, from pricing expectations, et cetera?
Right. I would start with an underlying sense of volatility. So using NMHC as, a very well-attended conference, I thought it was a very productive conference. There was quite a bit of cautious optimism is probably the best way to describe what I felt. Most of the people that we met with spoke to is an eagerness to become active again. And then Friday, the jobs report comes out. NMHC was not a month ago, and we were, at certain points in time dipping on the 10-year Treasury inside of a 340 rate, and now it's over 390. So the biggest challenge, I think, in the market that exists today is it changes so quickly, and when you're effectively forced to utilize agency debt for most transactions, which is a cash flow lender focused more often than not on certain debt service coverage ratios, it's going to put pressure on your in-place cap rates. So we do have a couple of deals on the market right now. We have a few others that were what I would deem quiet marketing. We've got a couple in front of you, Mike, that we are eager to see if we can make work. But that's the nature of the beast right now. We've got a deal that's in Class A deal, PSC deal, that is we are actively marketing. That's probably one of the higher CA counts and tour counts that I've seen in a considerable period of time. We have a B deal in North Austin that's calling for offers soon. We've been successful in putting together a couple of off-market deals. It's certainly not anywhere close to the level that was actively taking shape, the first quarter, second quarter of last year. However, there are groups out there, and I would say in profile, more often than not, they have a very attractive loan assumption, or they have been an owner of the deal 2017, 2018, and 2019, where the profit take on a sale is still very, very successful. It's a win. It's well beyond any initial pro forma that was put forward at acquisition, and there's a very healthy profit take. So those deals are going to, in my opinion, are more likely to see a full process play out, and that is a more likely seller than groups that, or 2021 and on buyers. I think that the market right now, from a buying perspective, there's a tremendous amount of liquidity, and the deals that do go out, more often than not, you feel like they lead with basis. So they're going to be a very attractive basis relative to not only replacement costs, but also peak sales comps that took shape over the course of last year. They're going to feel good from that perspective. And in doing so, they're going to drive the cap rate quite a bit lower. So it's not uncommon to see cap rates dive well inside of a 4.5, but more, I would say almost exclusively that in the event that happens, it's going to be at a purchase price on a per unit basis that is considerably off of what it would have looked like 12 months ago.
So you say so you're probably specifically talking about maybe newer construction, maybe say 10 years or kind of newer-ish when you're talking about a basis relative to kind of current replacement cost, because that metric isn't nearly as applicable on something in the 80s. And then so is it kind of, or my perception, you tell me if you share this, is that every buyer's out there trying to hit a 5 cap, but there's not much inventory as we talk right now. And the buyer pool is large, and you're getting a ton of CAs and a ton of tours and a ton of offers on anything that's out in the marketplace. So it's kind of putting a ceiling on kind of trailing cap rates. And so guys are just really, like you said, focusing on, well, this is a 20% discount to current replacement cost. So this feels pretty good, or whatever the discount replacement cost is. And so they're going to bite down a little bit and just kind of project that they're going to get year one north of a 5 cap and hopefully hit the year one cap rate around the debt rate, which is kind of in your mid 5s on the agency debt today. Is that a fair summation?
Right. Yeah, that's right. I mean, if you're selling 60s, 70s, or 80s product, conversation piece is very rarely tied to replacement costs of a new deal.
And so how much better would those cap rates be than something that's maybe 10 years or newer? And what are the main metrics that are driving the buyer interest and allowing them to move forward with confidence and taking a deal down?
I think there's still over the long haul, and what I mean by that is over the next 3, 5, 10 years in Central Texas, most believe, and I believe myself to be firmly in this camp, that it is a fantastic place to be buying. I think that you have to garner interest for a 70s and 80s deal plus or minus 5 cap, depending on location and depending on that's correct. That's correct. Circumstances may dictate otherwise, and there's going to be a storyline that possibly dips that lower or an undesirable location that possibly pushes that higher. But as a fair average, I would say plus or minus a 5 cap. We still have some pretty impressive migration stats, and I think there's a lot of pressure on housing and rents over the course of the long haul. I think there's possibly some softness to take place in the short term, but if you're a 5 to 7 year owner, then you're underwriting growth, if not right out of the gate, pretty shortly thereafter. But you have to have a storyline to really provide some confidence. So I think it's important to understand what people are gravitating towards and how you position an asset to effectively command an audience, which is a lot more difficult now than it is, than it has been.
So to illustrate a point though, so let's go back 12 months, that same 70s, 80s deal would have traded on a trailing 4 cap, maybe south of a 4 cap, because they're all betting on huge rent growth and value add stories. Would that be generally fair?
Yeah, I would call it quite a bit inside of a 4 cap. I didn't see a whole lot of disparity amongst vintages when it comes to a cap rate basis. We were routinely inside of a 3 in some respects. I mean, if you think about the first quarter of go ahead.
No, I was going to say, finish your thought. I'll put a point on it at the end.
If you think about what all kind of played out in the first quarter of last year, it was coming off of hands down our best organic rent growth year ever. So for effectively 0 and spreads on a debt fund execution that were 250 to 300, depending on vintage. So your financing rates were plus or minus 3, if not inside of that. And you're going to get 70% leverage. So that commanded a pretty tight cap rate. Then, all of 22 happened and we had numerous rate hikes, and that SOFR rate now is, if I'm not mistaken, 5, if not slightly over it. So that has just completely changed the game. It's effectively eliminated the debt fund or bridge loan execution from the market because it is so expensive. And Now we're reverting back to what we saw play out immediately after COVID, which is a marketplace that is 95+% of the time looking to Fannie and Freddie to finance the acquisition. That's a different profile because Fannie and Freddie are going to, outside of a pre-stay program, they're going to mandate certain debt coverage ratios be met in order to issue leverage. And leverage is still very low, which I think underpins an understanding within the market that there's a ton of liquidity. So, I mean, pretty much over a 12-month period of time, we've gone from leverage in the low 70s to leverage in the mid 50s. And no one really blinks an eye at that for what it's worth. They ideally would be higher, but I mean, that's how we're pricing deals right now.
Yeah. And so to illustrate that point and kind of my kind of hypothesis of where the workforce housing is trading is, you went from, say, a 3 cap to a 5 cap on a trailing basis. But last year, 2022, we still had, albeit slowing, but pretty tremendous rent growth. So that owner likely bought the deal, implemented some sort of value add strategy on an 80s deal, and probably moved their income somewhere between 10 and 15%. So maybe some cases higher by, trading these leases out at much higher rents. So they moved the income up quite a bit, but then the cap rates expanded. So all in all, we're seeing kind of from the peak pricing of the 80s to kind of what deals are trading at right now, probably a 20%, maybe 25% price adjustment from Q1 execution last year to Q1 execution right now. Is that fair?
Yeah, I think it'll more often than not, it'll be inside of 20. The toughest thing about answering that question is you don't have much inventory, so you don't have much pricing for the first time in a considerable period of time. I obviously know what we have, but I know most of what my competitive set has because they're all like us. They don't have a whole lot that's on the market, and they're probably trying to jam deals off market just as routinely as we are. My point in saying that is there's not that much out there, so the data points are limited. There's no doubt about it that we are more than 10% off of what I would call peak, again, first quarter of 2022. But there's really no distress in the market. That's one point of emphasis I would make to anyone that's listening is right now, in my opinion, there is not distress. You have sellers of circumstance. They are still profitable. They're in a position to transact. We'll see how the remainder of the year plays out, but the deals that are being taken out to market, and I'll give you an example because it was a deal that you looked at, but we had a deal in San Antonio that we priced in July 4th. We repriced it again in late September. It was about 10% off. It became a very attractive basis. That seller chose to go to market, and we were completely covered up in offers. For a San Antonio 2016 really well-located deal, that was plus or minus a 4.5 cap, in my opinion, on our underwriting. And we had a herd of 12 to 15 groups that were at a 5 cap. Well, it only takes one. We had 4 groups that were north of 50 million, and we had 15 that were between 48 and 49. So we were able to conduct a process that was a pretty competitive one, and we didn't even take it to the full length of what we probably could have because we had a really damn good buyer step up, and that deal closes in a week or so. That's an indication of you lead with basis. 2016 deal in a really good location within San Antonio, call it low 180s a door. You're going to have a flurry of interest on a deal like that.
Before we move on and put a fine point on it, is it fair to say what I gleaned from what you just said that, the Class A kind of 10 years or younger or vintage, it's relative to a replacement cost basis. And that is most of these deals are trading kind of plus minus 4.5 on a trailing cap rate. And then the buyers are performing something north of a 5 year one. They feel good that they're getting a deal leading with basis relative to current replacement cost, which hasn't really come in materially. Replacement cost is still kind of generally up there. And then switching to kind of your more 70s, 80s workforce housing deals. Those deals are a basis, but where the reference point you're comparing it to is kind of the peak trades of Q1 or Q2 of 2022. And those deals are, 20%, maybe a little inside of that, off of kind of the peak, and people feel good about a relative recent trade, and they're getting a relative value to 12-month ago pricing, and they're kind of biting down and settling around a 5 cap with probably your pro forma pushing in the upper 5s or 6 year 1 year 2. Is that pretty fair?
That's pretty fair.
And there's no inventory, very limited inventory. So you dump a ton of inventory on it, all that could change, right? Second half of the year.
Well, I think that's, in my opinion, sellers are going to get paid for being a first mover. So if you take the risk of going out right now, which I believe to be, we're hitting values, our BOVs are striking. I would be the first to admit that our BOVs in the second quarter of last year did not hit. We were off on the high end. But right now, we've got a pretty firm feel for where value is. We understand that the demand out there is pretty significant. The level of inventory is incredibly light. If you want to call it a scarcity premium, I think that would be a fair description of where we stand currently. If the Treasury had stayed in that 350 plus or minus 10-year, if that index was 3.5, there would be a hell of a lot more on the market. I think pricing would be within the same range that we just elaborated on. It will be interesting to see if people start taking deals to market to kind of beat a possible wave, because I think they're going to receive a slight premium for it because of these cap rates being low, just a function of when the broader wave comes. I'm not convinced that it doesn't happen sooner than later. I just think it's probably going to start with the older stuff.
You're foreseeing the workforce housing guys go out more en masse in the Class A and Central Texas?
Yeah, I would expect. I mean, yes. If the profile deals from a category standpoint, I would say that the older deals are probably the first that are going to start transacting.
Is that a function of in 2021, early 2022, any deal that had a CO could clear the market at stabilized pricing, whether it was stabilized or not? So a lot of those deals that would be ready now or kind of got brought forward, and the deals there's a lot of deals under construction, but now they all need to be more traditionally fully built and stabilized before they go to market because not as many groups are taking them out pre-stab. Is that a function of it, or is it just because, I mean, you guys have obviously built a ton of multifamily in Austin over the last recent handful of years. So there's certainly quite a large expansion of the supply. So you would imagine that there'd be quite a few of those, and by nature, the majority of those are built by merchant builders. That the business model is they build, lease, sell, no matter where they are in the cycle. For the most part, they don't have patient capital. They got to turn them. So you would think those guys would be motivated to go as soon as humanly possible.
Yeah, I think it's going to be challenging, if not outright impossible, to be 20 to 30% leased and hit on anywhere close to a real market value. I think you have to lease the property up. You don't have to be 90% occupied, just for clarity purposes. I mean, you're not talking about being completely full, but you're going to have to be on the tail end of your lease up to transact. And a lot of that is just understanding that most capital sources for debt are going to require some element of stabilization. And that just goes back to the debt funds being largely out of market right now because of how wide they price relative to agency.
So the other thing, before I let Paul get a chance to hop in here, I noticed last 12 months, you mentioned earlier on this call, the rise of the PFC buyer. It seems like every deal out there is trying to either become a PFC conversion, or a lot of developers build a PFC, which is Public Facility Corporation. So essentially it's they build it, they have to keep a certain percentage of units affordable, and they get a full tax abatement. And it seems like that might be, in my opinion, kind of a moment in time. And I think the state legislators and local municipalities are realizing they're eroding their tax base by doing this. And I don't know what the greater good is for the local community, but that's one man's opinion here. But not to get too political about it. But are you still seeing every deal trying to be PFC right now, or what's kind of the current state of the market with that?
Oh, it's most certainly more popular. It's more popular now than it ever has been. There are pieces of legislation. Texas is in session right now. There are pieces of legislation being proposed that are going to change it or have the potential to change it. The delicate balance is yes, do these deals get taken off the tax roll? They do. The thresholds, I think, are likely to change. And what I mean by that is that the affordability that is instituted once converted and or built probably changes as well, with some lower designations to AMI being mandated within the PFC structure. One thing to be mindful of as it relates to PFC and just the broader Central Texas market is that affordability is a real problem. And, we've had some pretty impressive rent growth, and we have some challenges when it comes to affordability. So it's not all bad. It's not all good. There are some question marks on the future of the PFC right now. I think that it is, if I were to guess, my estimation is that it is not completely eliminated, but it probably changes in some form or fashion, to take shape early next year.
Yeah, I would probably agree with that. What we've seen, just even the Dallas Morning News today had a big article talking about how much taxes were not paid on these properties because of the PFC model on apartment buildings. So I know there's legislation that's currently being reviewed to maybe reduce it, but I agree with Matt. I mean, you have to have affordable housing, and you just can't stick on affordable housing just crappy apartments. It has to be nicer apartments, and so there has to be some diversity in affordable housing with nice properties too to offer that type of stuff. And so I don't think I see that going away. But Matt, tell me a little bit about institutional buyers. Are you seeing very many institutional buyers come to the market? You may maybe pay for these properties in cash with the hope that when perhaps rates come down, that they can refinance and pull the cash out looking for deals. And then also, have you started to see some distress and opportunistic buyers trying to come in and pick off these deals?
I'll start with institutional capital. As we entered into the new year, I felt as though the vast majority of active institutional participants were largely sidelined. I do believe there to be an underlying need and ultimate desire to buy. I don't think you're going to see a ton of institutional sellers, but that's going to be circumstantial, and you can't really approach these questions in a blanket statement. But I will tell you that private capital is going to outpace institutional capital, in my opinion, in pursuit of the deals that are taken to market right now and in the short, call it the next month. Everyone wants to become more active again. There was a point in time where bigger was better, and I hate to just continually revert back to first quarter of 2022, but I think that bigger was better in most of 21 and certainly the early part of 2022. So you saw portfolio trades very routinely and pretty impressive in size. Right now, I think it's actually better to be a less than, call it $70 million offering. And a lot of that is just a function of high net worth individuals, family offices, high quality syndications, groups that have the ability to raise money and do so in impressive fashion. They are taking advantage of opportunities that they believe to be only available within a short window of time. So they're going to outpace those groups. And we'll see when it kind of hits on all cylinders, but I think it's sooner than later.
All right. And Michael, any final comments for Matt or yourself concerning Central Texas?
Yeah, maybe. Is there any? We kind of been talking generically here, but obviously you cover two very distinct markets. Is there any material variation right now in demand or anything that's kind of quirky between Austin and San Antonio that's different than kind of historical norms?
No, I think San Antonio, if anything, has escalated up the ranks within the state of Texas, and I think it's very attractive, and it's become far more attractive because it is a more affordable market. It's also a very large market, and it has experienced the same level of growth, maybe to a lesser degree from a percentage standpoint. But I think San Antonio is going to trade inside of historical norms when it comes to a cap rate equation, whereas Austin used to outpace it. I think it's got a lot to like about it.
Got it. And I guess finally, if there's anything, one little subsegment of the marketplace that maybe you like the most right now, where you kind of, is there anything you're kind of seeing relative value as you kind of look across ABC, Austin, San Antonio, different submarkets? Is there anything kind of standing out to you that seems like it's not getting the attention that it probably should? Like, core Class A or suburban workforce housing or something like that?
In my opinion, I think there's an opportunity to pick off small portfolios of newer built product. And this is a speculative comment, but I think there's going to be an opportunity in the coming months, if not year, where you can possibly bundle up a smaller portfolio of well-located, relatively newer in vintage, if not outright in the process of lease up. That may be a pretty attractive buy where you're taking some risk off of the table for these larger merchant builders that have a lot of inventory hitting the market. Those are super interesting to me. I mean, keep in mind that deal delivering now was started 2 years ago. It's a completely different cost environment. Their bases are quite a bit lower, and they build good product. And I think the growth project prospects of this region over the long haul are incredibly favorable. And I mean, if I had just a ton of money, that's what I'd be pursuing.
Got it. Paul, anything as we wrap up here?
No, I think Matt's done a great job of kind of explaining what's going on in Central Texas. We certainly do like Central Texas. I mean, that's part of the golden business channel in Triangle, in multifamily and business and growth in Texas. We certainly do like Matt and the ability for Matt to kind of explain what's going on. So Matt, thanks for being on the podcast. Matt, if people want to get more information, maybe to visit or chat with you, what's the best way for them to get a hold of you?
Just look at our website, call my cell phone, email me, email anyone on the team. We're a very cohesive group. So you talk to me, you talk to anyone on the team, you're going to get a full download of what's going on. But we appreciate the outreach, and we're happy to help anyone that's interested in inquiring further.
Hey, Paul, before we go, I know you have the next speaker series coming up here soon. What do people need to know about that?
It is March 22nd. You can remember it because it's the next Fed rate hike. And we'll have JP Conklin with Pensford come all the way over from the East Coast to visit us. Well, there'll be 300 people in that room. Plus, to kind of figure out, is that the last rate hike or do we have another one coming? And what's the possibility of having interest rates fall? So it's always a great presentation from JP. We've had him on numerous times. In fact, Michael and I were just on his podcast this last week. So we appreciate him supporting the Old Capital podcast, and we certainly do like all his wisdom and ideas about what's going on. So
how do you sign up for that, Paul?
Go to the oldcapitalpodcast.com, oldcapitalpodcast.com. There's the ability to get into RSVP. That's what you want to do, is RSVP to the event. And thanks for bringing that up, Michael. I almost forgot.
I'm here for you.
That's good. Matt Pohl, thanks for being here for us. We certainly do appreciate it. Michael Becker, thank you. And I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.